Bruce Griffin, good to see you.
Good to be here.
Big day today. You have accomplished what not many junior mining companies do actually accomplish, and that's actually getting into production. You see around 2,200 listed mining companies across the 4 major exchanges around the world. I'd say a very small fraction of them actually get to this point, and especially not on budget or on time. So tell me about the project. How did you get there today?
Yeah, I mean, very, very exciting day for the project and everyone who's been involved in it. You know, our partner Yan Steel, the KMS management, key contractors like Grez. A lot of effort over a lot of years now, but ultimately, starting up on time and on budget is an amazing achievement. First ore in the plant a couple of weeks ahead of our schedule that we set at FID is a very, very pleasing outcome.
How did we get to this point? Because obviously it's been a pretty quick transformation since FID. Maybe you could just take a step back, remind us actually what's been happening on the ground, what's been happening at the company level since FID.
Yeah, I mean, it's interesting. FID, a little over a year ago. FID was in early October last year, and we're a little bit unusual at FID. We're already 45% complete because we'd been spending equity that our partner Yan Steel had contributed. At FID, we'd secured all the funding, 45% complete, but we had a wet season to get through, so construction right through the wet season, through into the dry. By the middle of the year, we were sort of 90% complete, and then it really is in that, there's a lot of stuff you have to do between 90% complete and 100% complete in startup. So we started waste mining, opening up the pit, in order to install the mining unit, commissioning all of the peripheral equipment like power stations and water supply and so on. And then, right at the end, actually commissioning the process plant, making sure it was all ready to receive ore. And, that really culminated in what's happened now, which we sort of call the start of operations. We put ore in the plant for the first time. It's the start. It's not the end of the beginning of operations sort of thing. There's a lot of work from here as well.
Well, there is. So why don't we talk about that? So you've just put ore in the plant. Things are looking good. What are the next steps?
Yeah. So I mean, in sort of a sort of key milestone sort of perspective, what happens now is, because we're making concentrates, it's a relatively, what I would call a short process. You don't have a lot of process steps. So within a few weeks, we would expect to be making our final concentrate products and actually starting to build stockpiles. As we head towards the end of the year, we'll be starting to move stock effectively from site to the port, positioning stock at port in Broome, ahead of loading ships for the first time. So we're still on track for our first customer deliveries in Q1 2024. And in fact, we probably think early in Q1 now, given we've been able to start the operations a couple of weeks ahead of schedule.
What are the risks here? Because obviously there have been other mineral sands companies that have got to roughly this stage before and have run into problems. How are you mitigating that? How are you looking at the project? What could go wrong? How are you going about, I guess, risk management at this point?
Yeah, I mean, there's probably a couple of things there. One is, I mean, startups are never, sort of, some people sometimes have this idea that, there's this big button and you press it and that's it, you're operating. It's not really how it works. You've got a whole lot of individual pieces of equipment that you're, one by one starting up, and then you've effectively got the whole process running, and then you're learning how to make it all work properly, optimizing performance, slowly bringing up throughput, maintaining product recoveries and so on. So that process actually takes 6 or 12 months in reality, the full process. Now you get a long way up the curve quite quickly, but there's a lot of work to get to squeeze the sort of last bit of production and so on out. There's some other things that we've got that perhaps are going to help us relative to perhaps what some other mineral sands operations. So if you make final products, which a lot of people have historically chosen to do, they're sold against a very hard specification. If I'm making premium zircon, it needs to be premium zircon. If I'm making a zircon concentrate, it needs to contain zircon and it needs to contain, an appropriate amount. But if we're targeting 38%, if it's 35, we can still sell that. It'll just have a slightly different payability. So what that means is we don't have to focus on the product quality as much as throughput and yield. So that relaxes some of the constraints you have when you're trying to start up against really hard product specs. And we've done a few other things. We've got a large tailings dam. It's good for a couple of years. What that does is it allows us to disconnect the sort of planning of tailings deposition from mining. And in the early stages of an operation, you want as much to be able to run things sort of independently from one another as you can. Otherwise, if you have a problem somewhere, it cascades through the whole plant. Whereas if you can disconnect things, that helps a lot.
I guess something that you're probably putting a lot of attention in, or at least KMS are probably putting a lot of attention into now, is staff and labour. And obviously this is going to be a big operation. It's going to need a lot of people. It's going to fund the local economy quite substantially. How is that going? Are there any challenges there in terms of finding the right staff, finding the right people, training them?
Yeah, I mean, it's been interesting. We've we've substantially hired the operating crew. Actually, by WA mining standards, it's not that big. We only have about 120 staff in our operations, plus about the same number from contractors. So it's not, it's a bit different to like a iron ore operation or something where you can literally have thousands of people. We've had a different value proposition hiring for people to live in the Kimberley mostly and so on. It's not a traditional mining area. It's actually a traditional tourist area, which is a bit of a sort of plus and minus, but it does make it an alternative, attractive location for people. What we've also done is we've seen that particularly trades continue to be an area which is more difficult, but we've worked with GRES, our contractor, so some of their tradespeople will actually stay on site as part of a transition. So what we've done is sort of where we've seen it's hard to hire in the market, we've used our relationships with the people we've been working with so far to make sure we're manned for that startup.
So obviously you've said on time, on budget. I wouldn't mind a bit more context around that, because obviously we usually, and I'm not saying this is going to happen with you guys, I'm hoping it won't, but we usually get to this point where ramp up begins, mining companies have spent their capex and a little bit of their contingency, and they're looking at potentially going back to the market to raise some more money to really get the full job done as they're ramping up and there's still costs incurring. Is that something that you're expecting to happen at Sheffield?
No, it is interesting. I mean, we get the question a bit about what is on budget and so on mean. Effectively there's a few pieces to this. So the actual build itself, we will have built the project without using all of the contingency associated with CapEx, which is a fantastic outcome. Yeah. We also had a pretty significant cost overrun facility and working capital allowances and so on. So, I mean, what we really mean by on budget, like, yes, we delivered the build itself on budget, but also we had an adequate funding envelope. So we've got, I'm waiting for confirmation of actual numbers, but we're expecting to have more than 50 million Aussie dollars of free, unencumbered sort of cash or funding available in the joint venture as we start up. And what that means is that, that's basically available to help fund the ramp up. Now we would expect peak sort of cash usage or peak debt draw, however you want to think it, occurs probably in the late in the first, early in the second quarter of actual deliveries to customers. So for us, sort of late Q1 next year, you build up working capital, you've got to operate for a period of time, you've got to receive money from customers. That's my experience of often where people have the problem is when you're doing the initial funding, you ultimately probably don't quite raise enough money. And then if you use up most of your contingency, you're sitting there going, and there's just not enough buffer left to manage that ramp up. So what we did, I think, a little bit different was we adequately funded it. So we had a good buffer to start with, including the cost overrun facility, which is still available to us. But we've also not used up all of our contingency in a capital cost overrun. If we'd had a 40% cost overrun like some projects have, the cost overrun would have already been spent. So, it's a combination of being adequately funded but also executing well means that we believe we've got more than enough money in the joint venture to see us through. And we actually have a pretty big buffer at Sheffield. And we got a dollar for dollar funding commitment with Yan Steel. So between the two of us, in the unlikely event that more cash is required, we could probably put another $30-40 million into the joint venture before Sheffield would have to go to its own shareholders.
So in your mind, I guess the development risk at this point is quite negligible. You've got a simple flow sheet. You're very well funded, and you've got partners if anything does go wrong in your sales with enough cash to make it right.
Yeah.
Talk to me, obviously you were talking about peak debt drawn end of Q1, early Q2, but that's at a point when shipments are going to customers, so I'm assuming you'll be generating cash at that point anyway.
Yeah, the way I've sort of often tried to articulate this is that if you think about the financial year 24, which is effectively, September, the current quarter, the December quarter, we've finished off the build and we're starting operating. It's all cost, right? Yeah. The first quarter of next year, we're not building anymore. We're continuing to operate, and we're starting to make shipments to customers. So we're starting to receive revenues, but you're certainly not getting a full quarter of revenue. So the second quarter is probably, it's a bit of cost, it's a bit of revenue. It's probably a bit of a wash. You get to the third quarter, while you're still ramping up, you've basically got a full quarter of production costs and revenues. We would expect that to be an actual cash positive at the operating level. And so over the 3 quarters, it probably sort of balances out that, you sort of build it up that way. So that's why that sort of peak debt draw is as you're transitioning from sort of a quarter of partial operations to partial sales to full sales is when you really turn the corner and are paying all the bills from cash receipts from customers rather than still using the funding facilities.
And what about operational costs? How much do you think that would have changed since FID and when you looked at that?
It's a really good point. We've seen inflation. People talk about it. It's a real thing. We were kind of fortuitous. As part of the process of securing the debt, you have to agree the assumptions for the debt model. And in consultation with the engineering, effectively the external expert that the lenders used, they actually asked us to use a plus 10% assumption on operating cost. And our project's really robust, so rather than arguing with them about it, we did that not only for the debt model, we actually used that for our internal model as well. What that means is that as we saw inflation, particularly manpower and energy related, we actually already had 10% built into the cost. So while we've seen inflation in our operating costs, we've not seen our expected operating costs change sufficiently to have to update our assumptions at FID.
It's quite a unicorn in a way. You're from FID by the sounds of it, in terms of you've actually used higher cost assumptions, lower commodity prices, worse exchange rate. So along so many different metrics, you're actually above where.
And I guess that's probably like the terms like world-class get thrown around a lot for projects, but the way I think about really good mining projects have a fair bit of like buffer in them, for want of a better term. Like they're really robust. And what that means is you can load a little bit of extra capital cost on. We're going to assume an extra cost overrun. Let's assume the operating costs are a bit high. Let's actually assume that, the debt guys use low prices, so let's assume prices are low and actually a conservative ramp up. And you take all of those and the project still looks pretty good. That's sort of a measure of the project. Whereas if you have a more marginal project, you add all of those things in and you can't actually afford to load them all in because the project won't look any good. And so you end up not carrying those sorts of conservative assumptions. So the robustness of the project is what allows it to work for debt, but also we were happy to carry those assumptions in for our own economics as well.
And just remind, I guess a nice way to finish off, just remind us on what the economics will look like, because this is obviously a 50-50 joint venture.
Yep.
It'd be good just to remind us of how much cash this project will be generating and what the economics around it are.
Yeah, so in stage 1, we're looking at cash generation, sort of around about 100 million Australian dollars a year, our share. Yep. The reality is the first few years are going to be about debt repayment with cash sweeps and so on. So 24, 25 and into 26, the bulk of cash will go on repaying the debt. But from 2027 on, we should start to see that sort of 100 million a year, our share of cash flowing out from the joint venture.
And looking further forward, there is obviously one of the key things that you have said is obviously that you don't want to have Sheffield as another one of those companies that just reinvest investors' money on their behalf.
Yeah,
it's always nice to give a little bit back, but at the same time, there will be a portion of it that looks to Brazil, and I was wondering if there's any updates on Brazil.
I mean, nothing overly specific at the moment. We're going to do a big drilling program towards the end of this year and early into next year, which we believe will convert the exploration target to a resource. We're going to do a PFS, a pre-feasibility study, so that by the time we're exercising the option next year, if we exercise it, we'll know we'll be able to communicate the value proposition on Brazil, and we still feel pretty good about it as an opportunity. And we are hopeful that we'll see some developments on the licensing front that will give us the encouragement that it's a good place to invest. I mean, in terms of the question about, do you reinvest all the money? I think, there's a balancing act. If you distribute, 100% of cash and there's no growth, then, where's the upside for people? Yeah. But if you reinvest 100% of cash, you're effectively saying to investors, I know what you should do with your money. So we sort of think there's a balance there where we're sort of thinking at least 50% of the cash that comes to us from Thunderbird, it's our expectation that we would distribute that. The remainder, if we see opportunities to grow, and South Atlantic and Brazil is an example, then we can actually increase the cash flow in the future, but continue to look to distribute a growing. If the cash flow is growing, the sort of 50% share of that will grow over time as well, to try and strike that balance between growth and upside from growth with actually respecting, shareholders. It is the shareholders' money, and they should have some say in where it and where it goes. And we often get the feedback from investors. They say, if you return the money to us, when you've got something you need it for, and if you can show us that you've got a really good growth opportunity, there's a pretty good chance we'll put it back in there. Yeah. They'll put it back in again. So I don't think it's necessarily one of those where you say, because you might have growth in the future, let's store it all up, because I think that doesn't really, that's a bit, I don't know how you put it, but it's a bit lazy, because ultimately if a project's worth doing, you should always be able to track the funding for it.
Very refreshing to hear that. Bruce, thank you for your time.
Cheers, thanks very much.